Please join me in welcoming David Schwimmer, CEO of LSEG, the London Stock Exchange Group, a global leader at the intersection of markets, data, and financial technology. David is a long-standing speaker at FMQ, and David really brings a very unique perspective to FMQ, which I so appreciate. He brings a very global perspective, right? Being based in London and all over the world, he brings a very interesting, fascinating perspective. And the discussion is going to be moderated by Liz Hoffman, who is a distinguished journalist and editor at Schwimmer, where she leads coverage on global business and policy. And David, I've said this before, we value our partnership with LSEG greatly. But thank you. It's been a very long partnership, and we hope to continue it. So David is going to offer a few remarks, and then we'll have a moderated conversation.
Rena, thank you very much. It is great to be back at FMQ. Today's events are focused on technology and transformation in financial markets, which captures very well what we are doing at LSEG. LSEG, for those of you who don't know, a global provider of financial market infrastructure and data, works with pretty much all major US banks, brokers, asset managers, asset owners. And today we are using our position to bring innovation and efficiency to the market. And let me just give you a few examples. I'll start with the private and public equity markets. There's been a lot of analysis, a lot of discussion in recent years around the availability of private capital and the global reduction in IPOs. There are good reasons for companies wishing to remain private. They might be in early stages of growth and not yet ready to go public. Their shareholders might simply prefer to stay private and feel they have adequate access to capital. But both public and private markets have an important and often interconnected role to play in the economy. So we at LSEG asked ourselves a simple question. What if we could think beyond the binary, beyond public or private? What if we could bridge the gap between public and private markets to the benefit of both businesses and investors? Our new private securities market is an elegant solution. I spoke about this at a previous FMQ session, so really delighted to tell you today it is now officially up and running and available. Through the London Stock Exchange, this platform, this private securities market, will offer private companies and their shareholders, including employees, access to periodic liquidity through intermittent auctions. Private companies that use our market will effectively go public for a day or a set period of time. They'll use the same best-in-class infrastructure and technology that underpins the LSE's public markets. Professional and sophisticated investors will have access to the growth opportunities those private companies offer. And then those same companies will remain private after having benefited from the liquidity of public markets. We are replacing the opaque, costly, and time-consuming private placement process with the efficiency, the reliable infrastructure of the public markets, without the disclosure and regulatory requirements applicable to public companies. With our first auction expected later this year, this is a great example of the innovation that we are bringing to the markets. Now to another opportunity, our digital market infrastructure. In 2024, over $3 billion in DLT-based fixed income instruments were issued globally, a 260% year-on-year increase. But that is still a tiny fraction of one asset class. Our industry has a lot of costly and clunky legacy infrastructure throughout the financial system. Putting aside all of the drama, positive and negative, around crypto, blockchain has enormous potential to improve post-trade processes and reduce risk in the financial system. Our digital markets infrastructure, launched a couple of weeks ago, will deliver blockchain-powered scale and efficiencies for the full asset lifecycle of a trade, from issuance, tokenization, and distribution to post-trade asset settlement and servicing. We have built this platform in Microsoft's Azure environment, and it is asset class agnostic. The first use case is private markets. We have already welcomed the first clients to the platform and completed the first private fund transaction. We plan to add other asset classes as adoption proceeds. Our intention is also for this to be a regulated platform, potentially across multiple jurisdictions. And I'll end my remarks before we have a discussion with Liz by touching on AI. LLMs, agents, other tools are creating transformative opportunities to drive efficiency, productivity, and faster, more effective decisions. To deploy this technology at scale across our industry, we need to be able to trust the output that AI produces. This starts with the inputs, with the data. And trusted data is at the heart of LSEG's AI product. Everyone knows that low accuracy rates and hallucinations are an issue with current AI functionality. It will improve over time, but the starting point has to be high-quality data sets. Our data is unparalleled in depth, breadth, and quality, and we have an open, model-agnostic partnership approach, so our customers can use it to deploy AI wherever and whenever they choose. We're also creating transformative products that embed Gen AI capabilities and natural language functionality into financial workflows. And of course, we're using AI to drive efficiency, innovation, and growth across our own business. For example, AI has improved our data extraction efficiency by 30 to 40% and reduced errors by 50% or so. So our economy is going through a transformation driven by technology, and the financial infrastructure needed to enable that transformation must transform too. Financial infrastructure and workflow has long been fragmented and frankly challenging to use. From DLT to AI, technology is enabling radical change in our sector. And as we look to the future of markets, we need financial infrastructure that is trusted, efficient, and scalable, and LSEG is proud to be a leader in providing it. Thank you.
Hi, David.
Hello, Liz.
Everybody. I want to start with the macro. From your seat, you see these big trade flows, big money flows. What have you seen in the last, somehow only 8 months, I think it is?
So there's been a lot of discussion, a lot of questioning around the US positioning in capital markets, and are we going through some kind of shift of that dominance? And this was, of course, triggered by Liberation Day, some of the questions around the dollar. But when I look at it, I try to think about it in more of a historical context. And so today, the US equity markets are roughly 70% of global market cap. And the US as an economy is between 20 and 30% of global GDP. So that's a significant imbalance that I would expect over time is going to move closer to balance. That doesn't mean that the US equity markets have to go down to sort of 20 to 30% of global market cap. But just to give a little context around that, Japan today is about 5% or so of global market cap. In the late 1980s, Japan was over 40% of global market cap. So, and even 15 years ago, the US was more in the 40 to 50%. So these percentages move around a lot. And we're in a mode right now where everyone sort of has gotten accustomed to the American market's kind of huge dynamism and really driving that. I think we'll see some adjustment over time, whether it's driven by a change in terms of any particular sector, hard to say. But I think over time you'll see more of a normalization.
But isn't it a bit of a flywheel where you get these big valuations, you get these deep capital markets? You were talking about private markets earlier. I don't know exactly what the latest count is on unicorns to have been born in the US versus Europe, but it's incredibly lopsided, which is obviously your pipeline for the listings business. So assuming that tax dominance is going to be here for a little while, what's the mechanism by which those numbers start to even out?
So some of it is currency related. You saw the dollar appreciating over the last 10, 15 years at the same time that you saw a lot of capital going into the US equity markets, largely into the tech sector. And as we see some of that dollar depreciation, that has an impact on this. And so, you've seen, European investors in US equities have a much tougher year this year compared to US investors, for example. So some of it is currency related. Some of it will be geopolitical. And we have seen higher flows of funds into Europe, into the UK, and into the EU, really since April. Not a kind of staggering shift that is going to drive any kind of instability, but maybe I would say sort of a normalized increase.
Is that global investors hedging their bets, or are they using their capital to make some kind of statement?
Well, it's hard to speak about investors in a general way. I think you are seeing a number of investors look at valuations in other parts of the world, and that includes Asia, and includes in the Chinese markets, which have seen a significant pickup, and look at the valuations in the U.S., which is, depending on your view, I'll say priced to perfection in some ways, or other ways people may think, well, the returns merit that, and the growth trajectory merits that. I think that the geopolitics of what's going on in Europe, the rise in defense spending, the shift in terms of Germany's attitude towards spending and stimulus, all of those things are coming into play in this. And is there also a kind of underlying geopolitical question mark around the U.S. position, the U.S. Commitment to some of the rules of the road as we have seen them in the past? Yeah, that's a little bit of part of it as well, but it's hard to make a generalization about all investors.
You talked about, separate from dollar appreciation or depreciation, dollar dominance. Mm-hmm. Do you think the dollar for back here in 10 years is going to have this as central a role in global financial markets and trade that it does today? I
think the dollar will still be the reserve currency in 10 years.
Okay.
I think you are seeing a number of countries try to chip away at that. And you may see a modest sort of incremental shift in terms of other countries having a little bit of success in chipping away at that. But the dollar's role as the reserve currency, I think, will last for an extended period of time. And there may be some alternatives at some point, but it's hard to see what they are today.
Can we actually spin through like a quick lightning round some of the contenders, and you sort of give us your view on why they're not there yet?
Go ahead.
Obviously, the renminbi in China.
I think capital controls create a real. You need liquidity. You need freedom of movement across borders. So there are a number of reasons why that would be problematic today.
Euro?
Probably the closest contender today. It was not that long ago that people had very fundamental questions about the stability of the euro and the underlying political construct there. A lot of that appears to have been addressed, but I think that could also raise some concerns. But the euro is probably number 2 on the list currently.
Yen?
Not a big enough market.
Okay. And then, there was a time when the reserve currency of the world was the British pound.
Yes, there was a time when guilders,
Dutch guilders,
of
the Dutch guilders, so, nothing is preordained.
Right, these things move on.
Yeah. We'll have a new president in 2028, presumably. But like, if a more globally minded administration came in and said, just kidding, this was a mistake, we want to go back to multilateralism, multipolarism, we want these big globalized financial markets. Is this a one-way door or a two-way door? How much of the ratcheting up that we're seeing is going to get baked into the system and be a little permanent?
Is that around which aspect of a lot of the changes that we've seen?
So we're seeing a lot more bilateral trade agreements,
yep.
Trade that goes around the U.S., financial markets
yep.
that try to limit their exposure to the U.S. And I wonder how much of that, if the concrete hardens around it, people say, well, now we're just in a slightly less efficient world, but it's one that we've built and we're comfortable with it, versus kind of going back to a much more open system?
I think that there has been a relatively more fundamental shift. And it's not just about some of the current administration's policies. I think that this relates also to how countries found dealing with COVID to be very challenging. And that, if anything, was probably a key catalyst in terms of the shift from just in time to just in case, and really more focused on resilience as opposed to efficiency being the primary driver in terms of supply chains. So the political environment that we're in today is adding to that as opposed to being the initial catalyst. And I think if you're responsible for a country, for a government, you have to be very cognizant of how the world feels different now. And there is a different approach in terms of thinking about your supply chain, thinking about your capabilities. And I think it raises some important questions for countries as they think about their natural resources, as they think about their technology positioning, their access to capital.
Let's talk about your business. The London Stock Exchange is 3/4 of your name. It is not 3/4 of your business, but it is the public face of the company. And I'm curious what you make of the declining number of listings there, a smaller share of IPO, new IPOs coming to London. There's rumblings of some really big FTSE names kind of making the shift. How does this keep you up at night?
So we've actually made a lot of big changes in terms of the UK listing regime and making it significantly more attractive. First point I should just say is London continues to be by far the leading listing destination and capital market in Europe. And when I say by far, it's so you can add up all the others, and it's still above them in aggregate. But there were aspects of the listing regime in London that had gotten a little bit long in the tooth. And some of the rules hadn't been changed in 30 years. So we've gone through a process over the last couple of years of making a lot of changes, some of them very significant and dramatic. And so London is now a much more flexible regime for listing. And we've seen that in terms of changes in companies coming, changes in the pipeline, changes in how companies use it. And so let me just give you a couple examples. And I love being able to do this at this event, because if I were to talk about these kinds of things at any other place, people would think it was very arcane.
This is your room.
This is, yes. So related party transactions. You used to have to get a shareholder vote to approve a related party transaction for a London-listed company. A shareholder vote that's a big deal. It's kind of a pain. Now you just need a vote of the independent directors on the board, which you can do in an afternoon. It used to be very difficult to use equity in an M&A process for a London-listed company. You had to submit a prospectus to the FCA and get it approved, which would take several weeks. And in a timeline of an M&A process, when you're often competing against a private equity firm that's just going to go raise some debt, that made the listed companies uncompetitive in M&A processes. We've changed all that. You don't have to go to the FCA anymore to get approval to use your equity. And we've already seen companies using that, and actually in one case recently beating a private equity firm in an auction process because they were able to use their equity. So a number of different things like that. There's actually one more that I should use that is also particularly relevant. One of the challenges in the markets today and in the IPO markets is the increasing prevalence of passive capital and the index funds. And so we have heard this from companies thinking about listing, and also from some investors, that when you don't have the passive capital participating in an IPO, that's a problem. That's a challenge. And then when the companies go public and then they are later included in an index, then a lot of liquidity comes flowing into them. So in the UK, we have just changed this, and when I say we, so FTSE Russell is part of our business, but we do not control how it deals with index inclusion. It has its own governance, which we think is very important, and it works with the industry on that governance. It went through this governance process to introduce what is called a fast-track entry into the index. And so now, if you are IPOing in London and big enough to be within the FTSE 250, then you will move into the index within 5 days. What that means in practice is that the index funds that track the index have to participate in the IPO, effectively as a price taker. So it brings all that capital into the IPO process and addresses that particular issue. So there are a lot of different things that we have introduced and implemented, and we're seeing the impact of that in terms of the pipeline building and more companies wanting to come. The broader issue, though, there are actually two issues. One, which I touched on in my remarks, there's plenty of private capital available. And so companies, if they don't want to go public, they do not have to go public. But there are still benefits to being public, liquidity, being able to use your currency, your equity as an M&A currency, being able to provide liquid incentive structure to employees, et cetera. But it is, there's an element of that that I think won't change in terms of the availability of private capital. There is an element of that that will change, and that is the fact that we have come to really the end of a 20-year interest rate cycle, where for a number of years, private equity firms had access to free capital. Now the capital is not free any longer. We're seeing the issues that that is raising in a private equity industry that got overextended. And so that may also lead to a bit of a resurgence in the attractiveness of the public markets.
We've got a few questions left, but we do have some time for Q&A, so if folks want to queue up at the microphones, we'll get to you in a few minutes. As companies stay private for longer, regardless of whether you can eventually coax them public, is there a concern that so much of the value has been extracted at various points by private owners that sort of by default, the public markets end up as bag holders? How do you make sure that there's ample room to run once these things do go public and not people just cashing out?
Well, so in this private securities market that I was talking about in my remarks, that is intended to address an aspect of that in terms of if a company can become a very large multi-billion dollar or pound company before it has to go public, are some of those early gains gone? By definition, yes. And are we trying to give investors access to that in a broader way through this private securities market? Yes. I think there's a very important disciplining aspect of the public markets. And so if companies come to the public markets and there's no upside, you see how that plays out. And when I talk to CEOs of companies thinking about going public, and this is in my current role, this is in my prior role as a banker, when I took a lot of companies public, people often have the attitude that the IPO is the end game, and that they want to get public and then they're done. It's actually the beginning. And it's the beginning of a life as a public company. And as a public company, you want to be constantly growing and improving and driving an improved share price. So if you see, there's lots of discussion about the equity markets opening and closing. Some of that is the disciplining factor of the public markets and investors. If too many companies come to market and they are value destroying, that hurts investor confidence. And then those doors can swing shut for a period of time. And then the companies that can reopen that equity market, there needs to be an attractive value proposition. So in many ways, it's sort of a dynamic or organic system that addresses
I think we've seen enough. There have been a number of IPOs in the last couple of weeks that there hadn't been before. Most of them have done okay. Is this the water's warm? What's your sense of talking?
I think we're seeing some of that right now in terms of companies testing the water, you got to be careful because there are a lot of, I don't want to disparage any particular community, but there are a lot of companies, some in private equity hands, that have been waiting to go public for an extended period of time. And so I think it's important to make sure from an investor perspective there's real value there.
That is their business model. We'll take a question from right over here.
Hi, Mr. Schwimmer. Thank you so much for taking the time. My name is Pavlos, and I'm a senior in the business school. And I'd be curious to hear more about the most pressing challenges that you have faced in operating an exchange that's so global in reach, and how you're thinking about overcoming them now and in the future.
I think, so I'll expand your question out a little bit in terms of, at LSEG, yes, we have the London Stock Exchange. We also have a lot of other businesses, some of which are super systemic. And I would say the big challenges come in those very difficult market moments. Whether it's, we saw a little bit of this in April, but certainly in COVID and other times where you get to a point from a market's perspective where our goal is to make sure that everything remains resilient and keeps running. And we are very focused on financial stability, risk management, et cetera. There have been some times over the years where I've gotten calls from banks saying, can you shut down the market? We cannot keep up. That's a scary call to get because our answer is no. It's really important to keep the market running. But that gives you a sense of what kind of strain is going on behind the scenes at some of these institutions. And so one of the things that we're very focused on is making sure that the plumbing in the industry works, both ours and all of the different institutions that we interact with.
Thank you.
Got time for one quick question and one quick answer.
Understood.
Keep us on time.
Mr. Schwimmer, thank you for speaking with us today. I'm Rohan. I'm a senior in the business school studying finance and business analytics. You mentioned how new technologies such as blockchain are going to revolutionize post-trade processes. Given how global LSEG is, what kind of is the roadmap for not only the implementation for these technologies, but how you're cooperating with international counterparties as well to keep standardization across the board?
So I will be very quick. We could spend a lot of time on that. We have been building this in cooperation with the industry. And one of the things that we have seen in terms of how others have built their platforms is they've built it in a proprietary way. And if you build it in a proprietary way, no one else in the industry is going to want to use it. We're very neutral. We have lots of partnerships. We have an open access model. And so we've been building it in partnership with others, and we've been engaging with regulators around the world. And so that kind of construct we think is most conducive to bringing in that broader adoption.
Well, thank you so much. A really interesting discussion. Thank you all for joining us.
Thank you, Liz.
Thank you, David.